All right, so do you remember the FANG stocks? FANG, F-A-N-G. I've been on Wall Street for a long time, and I've seen fads come and go. And the FANG stocks were one of them. When the market was really booming, people loved the FANG stocks. Now, why do we call them FANG stocks? F-A-N-G. It was Facebook, Apple, Netflix, and Google. Think of how much has changed. Facebook is really called Meta. Well, technically, I still call it Facebook. And Google is called Alphabet, although I still call it Google. So, anyway, I hope I'm not offending anyone, but I guess I'm just stuck in my ways. So, let's just take a look at these charts and see if we could see some interesting stuff here. So, here's Facebook, aka Meta, but I'm going to call it Facebook. And there's a lot of different lessons on this chart here. I can see, you look at any chart and you see a lot of the same similarities. And the reason why is because a chart is nothing mysterious or magical or mystical. It's just a graphical illustration of human emotions. So here we see that we have a level that was support. It became resistance. Well, why does this happen? It's because people get remorseful. They've experienced buyer's remorse. A lot of investors bought here around this level, which I think is about 190, 183. Oh, 183. Yeah, this is right there. And then when the price falls below it, a lot of the people who bought were like, man, I made a mistake. I want to get out, but I'm only going to do it if I can get out without losing money. So they placed their sell orders at the same level they had their buy orders. So we have these remorseful buyers placing sell orders, and if there's enough, the level that was support turns into resistance. We have here Facebook got above this level that was support and then resistance. And check it out, it became support for 5 days. Now, why would resistance become support? Well, it's the opposite. Seller's remorse. People who sold back here regret doing so when the price went higher. A lot of them say, you know what, I made a mistake, I'm going to buy my shares back, but only if I can get them for the same price I sold them at. So you have remorseful sellers placing buy orders. If there's enough of them, the level that was resistance becomes support. So in the institutional trading world, this is what people focus on. And I hate to keep bringing it up over and over and over and over, but these are the fundamentals. These are the fundamentals. And if you understand these fundamentals, you will be able to profit in the market. Now, you've probably heard the expression gaps refill, and this gap seems to be refilling very well. And we've been talking about this here at Stock Market Jobber as a potential short or a put trade if you're an options trader for a few weeks now, and it looks like our trade idea is playing out pretty well. And I would suspect it's going to keep going our way. My target is down around here for 160. Now, why would that be my target? Well, it was a former support level. Okay, so we've talked about the buyer's remorse, but we gapped up, and you've probably heard the expression gaps refill, and they do. And this shows you perfect example. You can even see it down here, but that's an opposite dynamic. We'll talk about that in a few minutes. Why would a gap refill? Well, the stock closed here and it opened here the next day. It didn't trade in here. So therefore, if it didn't trade there, you just can't have remorseful sellers trying to buy their shares back. It didn't trade there. So if it didn't trade there, how are you going to have someone who is a seller say, I want to buy my shares back if it didn't even trade there? All right. So there's going to be a lack of buy orders on the way down, or a dearth of buy orders on the way down, if you will. I kind of like using that word for some reason. Anyway, we're off to refilling here. Here we have the opposite, right? We dropped down and we got right back up really quick. This is because of the whole buyer's remorse thing, right? Buyer's remorse turns support into resistance. If this stock just trades down really quickly and it closes here and opens here, well, this is the opposite. It didn't trade there, so no one could buy it. So you're not going to have remorseful buyers trying to get out. When we look at these charts, we just have to think about supply and demand and what it tells us about human psychology. And you can see human psychology on any chart, right? We just saw buyer's remorse turns support into resistance. We saw seller's remorse turns resistance into support. This isn't magical. This isn't astrology. It isn't mysterious. It's a graphical illustration of supply and demand dynamics in human psychology. All right, let's go to the next FANG stock, which is Apple. And I won't rant as much on this one, but here we could see how a resistance level, this is what we call market memory, when there's a level that's important, and an important support or resistance level that retains its importance for a while. And one of the basic things I like to tell people or teach people, because I know I've been doing this for a while, is that there are some price levels that are more important than others. And if you can figure out where these price levels are, you can make money. Now, here we have Apple testing resistance around 155. When a market's going higher, there's not enough supply or sell orders to fill all the demand. When we get to a resistance level, the tide turns. All of a sudden, the sellers come out and there's more supply or sell orders than there is demand slash buy orders. And a lot of times we can get a quick reversal off of that. Now, why does that happen? Well, the sellers kind of start to sense that, oh, there are other sellers around. There's other sellers lurking in the wings. Pretend you're in a room, and it's the only room in the world where if you're trading this stock, you have to be in, right? Or the only place in the world where this stock trades is in this particular room. If you're in the room and you're buying and selling back and forth, everything looks cool. But then say you're a seller and you notice that some of the buyers are finished and they've left the market, and you notice some new sellers coming in through the door. You might start to get anxious and say, like, you know what, I'm not going to be able to sell this at this price. I better go lower because I need to be the lowest price in town, or else they're going to just buy it from someone else who's offering it lower than me. Someone sees you do it, someone else sees that someone do it, someone else sees that someone do it, and they just start undercutting each other, and we go into like a snowball effect. And I don't have it marked here. Let me put that there. But here we have a short-term support level. So up here we had resistance. Here we had resistance. Why would a level like this come back into play? Well, we call it market memory, and probably has a lot to do with psychology, like we were talking about. There are people who bought up here who regret doing so, who tell themselves, if I can get out as a break even, I'm going to once the thing went down. So they try to sell at their previous level they bought at. So once again, we're looking at market psychology. All right, let's see what's next. Netflix. Man, there's a lot going on here. I could rant about this chart for a long time, but I will try not to. All right, so what do we have? Resistance becomes support. Seller's remorse, right? People sell, it goes higher, they regret doing so, they want to buy their shares back at the same price, blah, blah, blah. Same thing happens here. Resistance becomes support. I don't know if I said that right. Resistance becomes support. Resistance becomes support. Here we have support becomes resistance. So we have seller's remorse. We have buyer's remorse. We have a gap that was refilled. One of the reasons why we have resistance is because we have remorseful buyers trying to get out at break even, so they place their sell orders at their buy price. When we gap through a level like this, there's no one who bought because it didn't trade there. So there's kind of a lack of sell orders. So buyers are forced to pay a premium, and that forces an uptrend. Now we get up here, we have an example of a short-term resistance, short-term support. My guess is that the market's going lower. There are some pretty weak fundamentals, or technicals, I should say. And we close around 348. 330 would be the next step because resistance becomes support. So how does this knowledge benefit you? Well, it's pretty obvious. It gives you insight into where you should place your orders, whether you're buying or selling. For example, if you think something's going to be resistance, you don't want to place a sell order above it. Say you don't look at charts, and say you're not a member of stockmarketjobber.com, and you buy a stock at 300 and it going up and up and up and up, and you tell yourself, oh, if it gets to 350, I'll sell it. All right, great. You're guessing. What if you look on the chart and you see, boy, 347 was a resistance level. There's a good chance there's going to be resistance there again. Or 347 was an important support level. There's a good chance that it can convert from support into resistance. Well, you have to let the market tell you what to do. You can't guess. The market is smarter than all of us, and the market is never wrong. So instead of saying, oh, I'm going to sell it at 350, I'm going to sell it at 345. All right, fine. It's not as good as selling at 350, but it's better than the stock getting to resistance, rolling over and going lower, and you just missed it because you just guessed. You didn't understand where the important levels were. Okay, let's go on to G, which is Google, right? I mean, they say it's called Alphabet, which I think is a pretty stupid name, but anyway, we see support became resistance. Resistance here. This last slide here shows us something that's called momentum. Momentum is how far a particular stock has moved between time period A and time period B. Most of the time, a stock is within its typical or usual trading range. If it gets above that, we call it overbought. That's important because overbought conditions attract sellers into the market. This bottom half of the chart here is what we call the relative strength index, and it's a way of measuring momentum. And in its most basic form, this blue line gets above the red line, it indicates overbought conditions. It's a basic principle of markets that when they're overbought and they get to resistance, they tend to sell off. Resistance, as we've seen, is a large collection of sellers or investors who want to sell. Overbought means something has been jacked up out of its typical trading range, and a lot of traders will be expecting a reversion to the mean. There's a lot of trading strategies on Wall Street that are based on this concept of reversion. And here we have this big move higher, we get to resistance, we become overbought, and sure enough, what happens? We go into like a free fall. Okay, everybody, that's it. I will talk to you soon. Thank you.